Let's start. Good afternoon. My name is Deepesh Mehta, and I'm very excited to actually introduce a new concept of investing. And it has been brought out by SEBI last 2 months back. And the whole presentation today is all about SIF, Systematic Investment Funds. Okay, so I'll just give a brief background of why this was introduced. Last couple of years, a lot of people started taking tips from unregistered people, and they ended up losing money. And essentially, those tips were given to actually tell that you could actually make a lot of money over a short span of time. So the regulator SEBI realized that but there is a need for a special product which is a gap. It's like I'll give an example that there's a 50 rupee note and there's a 500 rupee note, but all people need is a 100 rupee note as well, apart from your 50 rupee note and a 500 rupee note. So think that like RBI introduced a 100 rupee note to bridge the gap between 50 rupees to 500 rupees. The same way, there are mutual funds and there are other investment products, but there was one element which was missing in between that. And the regulator bridged that gap by introducing this product called as SIF, Specialized Investment Funds. So let me first take you through why exactly you need this. So do you have a decent sized mutual fund portfolio? I'm sure you would be having. And are you tired of exploring something called as PMS and AIF and disappointed with the poor returns? So basically, PMS are those products which are meant for an investment amount of about 50 lakhs and above. And AIF is meant for an investors who can invest 1 crore and above. So all these years there were mutual funds where you could invest every small amount, and then there was PMS where the investment starts with investment starts with 50 lakhs, and there was an AIF where the investment starts with 100 lakhs and above. In between this, there was something that was missing, which a mass affluent investors were actually asking for. Okay? So uh, but what had happened was that this PMSs and AF is not actually giving the kind of returns which the investors expected. Okay. And also, people who invested in stocks and PMS were paying high capital gain because of the taxation structure that the PMS had. So, as an investor, are you looking for a solution which complements your mutual fund portfolio? If yes, then presenting SIF, specialized in an investment fund, a new category of investment product which SEBI has approved. Okay, and we'll talk more on this. Okay. So what is SIF? So I'll keep things very simple. SIF is a type of an investment fund which pools capital into specific high risk areas of sectors. So think mutual funds. I'm comparing mutual funds with SIF because it correlates to it. So mutual funds have investment products which have low risk and also very plain vanilla product. But SIF are those products which pools capital into specific and high risk areas or sectors. It basically bridges the gap between mutual fund and PMS and AF. That's what I told you. That example of 50 rupees and 500 rupee note. There's a need for a 100 rupee note. Think this SIF has a 100 rupee note. They are targeted towards investors who are more experienced and who have been investing and understand the capital market well. Definitely, this is for not for a newbie who's investing his money for the first time, not definitely for a person who is actually breaking his fixed deposit and coming to capital markets. Of course, those of you who are joining here are well experienced, and this could be an investment product for you. Due to the specialized nature of the way that has been conceptualized, SIF may carry high risk. We will also learn why it is high risk, and but also offer a potential to deliver greater returns. Okay? They are designed for investors who are comfortable with moderately complex financial products and have higher risk appetite. So, as I say, I repeat this again, not meant for somebody who's coming this for the first time, but definitely meant for people who are comfortable with complex financial products. Okay. And more importantly, SIF is under SEBI regulation, providing a layer of investor protection. So whatever is being done in SIF is regulated just like a mutual fund product is regulated, and you don't see any scams in mutual funds. Same way, SIF is also regulated and it offers a layer of protection. Okay. So is SIF right for you? So we'll explore this. Okay. So first, let me first differentiate between an SIF and a mutual funds. The first thing is the first feature is the minimum investment. In an SIF, the regulator has kept a minimum investment of 10 lakh rupees. So if you have to invest in an SIF, the minimum ticket size is about 10 lakh rupees. You remember I told that PMS is 50 lakh rupees and AIF is 100 lakh rupees. And mutual funds were as low as 500 to 1000 or 5000 rupees. So between this mutual fund, which doesn't have any minimum, to PMS, there was a gap which was being felt in the market. And hence this SIF is introduced to fill this gap, and then the minimum investment required for this is about 10 lakh rupees. What's the product structure? There are many of strategies. Currently, there are 7 strategies which SEBI has introduced. I'll explain what are those strategies. In mutual funds, there are 36 predefined schemes. So in mutual funds, you have large cap, mid cap, small cap, flexi cap. Likewise, you have 36 mutual fund schemes. In an SIF, it is restricted to 7 categories. What is the liquidity? That means when can you get your money? So there are different types of SIF, as I said, 7 different types of SIF. Some are daily, that means you can withdraw your money on a daily basis. Some are closed-ended, which says that you invest now and then the SIF would tell that you can exit only on 31st December 2025. Or some could be interval like 50, every 15th of the month, or every 15th of every first Saturday of the quarter, or something like that. So SIF can come with 3 types of liquidity. Interval is where you have specific frequency gaps. Closed-ended, where they define saying that you can't exit before a specific period, or it could be daily also. In mutual fund, it is mostly open-ended, hence it is on a daily basis. So you would have withdrawn from mutual fund schemes. You know that if you ask today, then the money is in your bank account tomorrow or day after tomorrow. So mutual fund is open-ended. SIF have these kind of intervals. Portfolio disclosure, SIF also invest in securities. So they are mandated to disclose once in every 2 months, not on a monthly basis. In a mutual fund, all the portfolios are disclosed on a monthly basis. Short naked derivatives. I'll come. What is that? Yes. This naked derivatives, think the word as F and O. You would have seen all these futures and options as wording. Up to 25% of the money in SIF can go into F and Os. In mutual fund, it is not at all allowed. In a mutual fund, an F&O is not allowed. But the major difference that you see now, you see in an SIF is that 25% of that capital can go into F&Os. We see a lot of people losing money in F&Os when they try to do this on their own. But what will SIF now bring is that in that SIF scheme, 25% of that SIF can go and do F&O, which will boost the returns. Then what is a concentrated debt fund exposure? Up to 20% of that money can go into single paper, which is AAA rated. If it's a AA rated paper, then 16%. And if it's a single rated paper, it's 12%. In mutual fund, it is capped at 10%, 10, 8, and 6, which means if a fund manager feels that there is an borrowing that is being asked by corporate, and that corporate has 20%, and that corporate has AAA rating, then an SIF can give 20% of the invested money into that particular scheme, in that particular to that particular corporate. But whereas in a mutual fund, it is guardrail is put up to 10%. Taxation and the expenses, this is same as mutual funds. So whatever taxation you have in mutual funds, the same taxation is being provided for SIF as well. So I'll repeat, what is the taxation in a mutual fund? If you withdraw within 12 months, you pay 20% tax on equities. And if you withdraw more after 12 months, then you pay 12.5% tax. The same tax clause is applicable for SIF also. Clear? This is the primary difference between a mutual fund and SIF. Okay. What SIF can do that mutual fund can't do? Now let's go more deeper into it. SIF can take concentrated position in debt, potential for higher returns but higher risk. So as I said, in a mutual fund, it is restricted only to 10%. So a single paper can be only 10%, but in an SIF, it can go up to 20% in a triple. So they can take concentration bets. That's one. They can take naked short positions using derivatives, profit from falling markets. I'll cover this in the next slide, but for a moment, just make a note that they can take short positions. The long short strategies unlock absolute return potentials. I'll cover with examples in the next slide. What is this? And then the interval can be closed-ended the redemption can be interval, can be based on some frequency, like interval, like half yearly or quarterly or monthly. And so it can have limited liquidity. So generally in a mutual fund, what happens is that, since there's a daily liquidity that is a possibility, fund managers have to keep some amount of the portfolio into bonds, so that when there's a redemption that comes, then the bond can be sold easily and honor those redemptions. In an SIF, because there are no liquidity options that can be the liquidity can be decided by the fund manager. They can have an liquidity for an interval like 2 months and 3 months, so that they can deploy that money much better, because the fact that the fund manager knows that this money will not go out within 2 months or within 4 months, so the returns could be slightly higher. It is designed for skilled managers to capture opportunities across market cycles. So we'll cover more of this in the next slide, what I mean here. Okay. Now, I told that SIF have 8 strategies. Like in mutual funds, you have 36. Like 36 are like large cap, mid cap, small cap, flexi cap. So you have 36 categories. In an SIF, you have 8 categories, and I'll explain what are these eight categories. They are classified in, again, sub-classified into 3 asset classes like equity, debt, and hybrid. One such category in equity is called as equity long short, where minimum 80% should go into equities and 25% can go into shorts. Now I'll explain you what exactly is shorts for people who don't know. When you buy shares, what do? You buy a share today, and then you can sell this in the future. So for example, you buy a share today on 25th of July, and you can sell this maybe 2nd of August. So this is the normal buying that happens. But in stock market, you can also first sell your shares and buy it later. Okay, so you might be this could be very surprising for people who are hearing for the first time. You can sell your shares first and buy this at a later date. Now, who does that? Basically, if you believe that some stock price is overvalued, then you can actually sell that first and buy this at a later date when the share price comes down. That concept is called as shorts. So in an SIF, 25% of that money can go into shorting. Okay, so I'll give an example so that I can sell a Zomato stock at 300 rupees today and then buy this again at 250 if it comes down. So what happens is that my selling price is 300 and if I buy, my cost price will be 250. I make money here also. Generally, what happens when you buy a stock and then if it comes down, you lose money. But in a shorting, it's the other way. You can sell first and buy later. So that concept of selling first and buying later can happen up to 25% in an SIF, which is not possible in a mutual fund. Okay. Okay. So there's one category called as equity long short. Okay. So what does an equity long short tell? That I can buy something and I can sell something at the same time. I'll give you one example. Let's say if I am very, very bullish on India, that India will do well in the next 2-4 years, but I'm very, very bearish on American stock market or the Chinese stock market. I can buy Indian stock market. That means I can go long on Indian stock market and I can short maybe probably Chinese market or an American market, depending on what strategy that I use. So 80% of my money can go in India and 20% of my money, 20-25% of my money can go into selling something else, so that if stock prices in India goes up, I make money on this part, and if the stock prices falls down on that particular country or that particular index which falls down, then I make money on the both sides. So this concept is called as long short. Okay. So in this long short, 80% can be long and 25% can be short. So this is one category. The second one, so this can be done across any stock. Then the second category that has been introduced is that equity X top 100. That means, all stocks from 101 onwards. In this strategy, from 101 to the smallest stock, this can be long shorted. And the third one is sector rotation in long short. That means I can have 4 sectors. And in those 4 sectors, if I'm very bullish that financial sector will do well and probably consumer sector will do well, I can go long. And if I believe that IT sector will not do well, I can short an IT sector. So this is called a sector rotation long short fund. So this is on the equity. In this equity, only stocks can be bought. In a debt strategy, I can also do a long short on debt on bond papers also. That means I can buy bonds and I can also sell some bonds which I feel will not do well or the prices of those bonds will fall down. So this is called as a debt fund strategy. And then I can also have sectoral debt fund. That means I can buy some specific sectoral bonds. If I believe banking stocks will do well, then I can buy banking bonds can do well. Then I can buy banking bonds. I can buy probably an IT company bonds, because if I believe that IT companies will do well or will not do well, whatever is my strategy, I can do that. And then you also have another asset class, which is hybrid, where I can have multiple asset classes like equities, bonds, commodities, derivatives, REITs, InvITs. I can short in any of these things. So I can, for example, I can buy stocks, and if I feel gold will fall down, then I can do a shorting in the gold as well. Or if I believe silver would do well, I can buy silver. I can go long on silver. I can go short on gold, or I can go short on equity as well. So this is called as hybrid strategy of SIF. So these are the 8 different strategies that has been told by SEBI as of now, that mutual fund companies can actually work only in these 8 strategies. They have been well thought to ensure that there are not too many schemes which will confuse the investors. Now, how do these long strategies work? Because if you understand in all these things, all the strategies, the difference between this and mutual fund is the concept is long short, long short. If you see this long short, so it is, as an investor, it is very important for you. What is long short and how does it work? I'll cover this again. So I go long, that means I buy some expected winners. So I'll give you an example. So let's say there's a fund which is which is worth around 100 rupees. In this 100 rupees, I have bought some stocks which will do well. So let's say that's around 75% of that particular 100 rupees. I buy some stocks, stock A, stock B, stock C, stock D, stock A. I buy 5 stocks which I believe will do well. So I have bought at some X price, and I believe that the price will be 2x or 3x in the future. So this is called as long. But I also believe there are some stocks which will not do well. Believe that IT stocks might not do well because there could be a recession that could be coming. If I believe that pharma stocks may not do well because there's some global issues with related to the thing, then I can sell those stocks. Then I can sell those stocks. For example, I can sell pharma company A at about 1,000 rupees. Then I can sell one IT company B at about 600 rupees. The idea is that if I sell at 1,000 rupees, I should again go and buy this at a price which is below 1,000 rupees. And that concept is called as going short. So in this long short, what happens? If these stocks do well, I make money here. And if these stocks don't do well, I also make money here because I've sold this at a higher price. And if they don't do well, the prices will fall down. I can go and buy this again at a lower price. So, now on this example, pharma company A, I sold this at 1,000 rupees. I can buy this at 900 rupees back. So what happens is my selling price is 1,000 and my cost price is 900. I make 100 rupees on this pharma stock. And the other IT company example I'll take, 600 rupees is what I sold. Let's say that price comes to 400 rupees. So I make 200 rupees on this particular pharma company, of IT company stock. So I'm making money on this part of my portfolio. I'm also making money on this part of my portfolio. This is called as long short. So some examples which I could tell you is that, let's say within the sector itself, I believe that if Infosys will do well, I will buy more Infosys, and if I believe TCS will not do well, then I can sell Infosys. So I can maximize this, and this is what SIF will essentially do. It can do at stocks level, that is called as equity SIF. It can do at bonds level, and it can do at hybrid level. That means I can buy equities and I can sell gold. I can buy gold and sell stocks. So that can happen hybrid. The objective is this to tap gains both in rising market as well as in falling markets. Generally, all these years, you were not investing money when equity markets were high, thinking that markets kafi upar hai, markets are high, so I will not make an investment. What if the market falls down? So the answer for that is SIF, where even if stock market falls down, there's an opportunity for you to make money. So this is called as long short. Clear? What are the risks and other considerations? The first risk that I see is that the concentrated exposure. That means because SIF is very concentrated, you have a potential to get higher gains, as well as you can also lose money. You can also lose money because if I have bought this part of the portfolio going long, and if this falls down, but if this goes up, the sales goes up, then I make money on both sides of the portfolio. So there are higher chances that I may make a loss as well. Then shorting derivatives are higher, have higher complexities. So not every fund manager can do. So there is a high complexity that is involved. That is why people don't make money in F&O, because it's a very complex product. But people may lose money because they don't understand this concept. And performance is manager dependent. Skill and experience matters here. So not all SIF will do well, and it is not suited for all. It is intended for informed market aware investors. So probably if you're making an investment into SIF, you also have to understand that it will fall much more than a mutual fund can fall. So you have to be an evolved investor to make this investment. Should you invest? Yes, if you should invest if you're looking for greater flexibility, higher returns, but also okay to take higher risk of capital losses. Investors looking for relatively absolute return in all market conditions. So basically, in an SIF, you make money even if stock market falls. Generally, you make money only when stock market go up, but an SIF can help you to make money when if stock market falls. And it is suitable for people willing to understand and bear high risk and complexity. Ideal for investors looking for active, flexible portfolios and advanced strategies. This was once available only for high net worth investors. So when I spoke about this AIF also does a similar thing, but that is done at an a value of about 100 lakh rupees. So not everybody we're having 1 crore rupees to make an investment. Now that has been brought to about 10 lakh rupees. So the minimum investment is 10 lakh rupees. Once which was available for only for high net worth investors is now available for mass affluent as well. It offers flexibility and risk reward opportunities. And due diligence is essential. Choosing managers with a demonstrable track record is important. This is what we will be doing for you. That now that SIF is getting introduced, a lot of companies will come up and offer SIF. We'll be making a research on which SIF to avoid and which SIF to invest. So important slide here. So where you should use SIF. So this is your wealth pyramid. In a wealth pyramid, what happens? You have a well-written investment plan that your investment strategy should go like this and like that. Then you do your risk management through insurance, through buying and health insurance, term insurance. You do your risk management. Then you do your goal planning through mutual funds and PPF and other similar products. So after this, if you have excess money, only then you should be exploring into SIF. So I repeat once again, let's say you have only 10 lakh rupees and you say put all my money in SIF, probably will not be recommending this SIF to you. But let's say you have about 50 lakh rupees, then we may come out and tell you that probably in this 50 lakh rupees, about 10% can go into, about 10 lakhs can go into SIF, because on and 50 lakh, if 10 lakh goes, then you're only putting 20% of your money into high risk strategy, but the rest 80% is through mutual funds, which are perceived much more safer and lower volatility compared to SIF. So my advice is that somebody who is having less than 50 lakh rupees, even if you have 25 lakh rupees, you should not venture into SIF. Then you will build a concentration risk on SIF. But if you have a portfolio or you have a network above 50 lakh rupees, then definitely SIF can make sense to you. Okay. Okay. Why happy investors? To recommend SIF to investors, one have to clear a very tough examination, and then I have cleared this examination, and a very limited number of entities, people have actually cleared this examination. The passing mark is about 60, as high as 65 percentage. I have cleared this examination, and because I understand this very well, so it was very easy for me to clear, and we have now taken the license to recommend SIF to you, and hence we are here to guide you. So currently, SIF are not being offered as I speak today. The construction is under process by mutual fund companies. Probably we believe that in the next 30 to 45 days, the first SIF will come. And once it comes, we will evaluate internally whether recommending that first or second SIF which has come makes sense or not. If yes, then we will write to you saying that we could invest in SIF, and you could make your investment. There's no separate KYC or anything as needed as such. And when you invest in SIF and when you look into your Happy Investor portal, you could see that SIF as a part, as another scheme in your other schemes that you've invested. Okay, I stop here and then I am happy to take questions from some of you and explain this if you have any questions on this. So happy to take any questions. So if you have any question, please unmute yourself and ask those questions if there is any.
Hello, Deepesh. This is
Yeah,
Upasana.
yeah,
Thank
hi,
you.
Upasna.
Hi. I think above
Yeah,
all, I think it's always interesting to be part of webinars because you get to introduce to what is the new latest products out there in the market. Um,
yes.
the only thing that I want to know, and of course I'm just like understanding this, is that what's
Uh,
the worst case scenario? Let's say you have 10 lakhs excessive, you know, income that you can put into it, and there is
uh,
a higher, return that you can expect. There is a risk
uh,
involved as well. But
yes,
let's
yes.
say if there is like mutual funds, if you're looking at a longer term investment of this without
Hmm,
touching it, do you think that
hmm.
equalizes the risk?
A good question. So your question was, what is the worst that can happen? Okay. So there are basically two risks universally. One risk is called as credit risk. What does a credit risk is that you put your money and then that money vanishes. It's like you put some money in a cooperative bank and that bank closes. So that is called as credit risk. So such risk don't exist in mutual funds or in SIF. The other risk is called as volatility risk. Okay? That volatility risk is slightly lower in mutual funds compared to SIF. In SIF, the volatility will be much, much, much higher. You have invested 10 lakh rupees. Probably a week later or a month later, this 10 lakh can become 8 lakh rupees also at that point of time because of different market fluctuations and the strategy not doing well. So the worst thing that you could think is that you'll have higher volatility. On the other side, if you see the way the regulator has structured this SIF is that 75% of the SIF is nothing but your mutual funds. And the 25% is left out to play out on the long short strategy. So 75% of your assume that even if this becomes zero on a worst case, this 75 will still grow, and that 75 at 12% return can become 82, and then 82 can become 90, and 90 can become 100. So in 3 years, probably that 75, that out of your 100 rupee, that 75 percentage can become 100 if market delivers 11-12% return. And even if that worst case, if 25 don't deliver also, you'll still have a bit of capital protection that you could see when you stay invested for 3 to 4 years. And this is how the regulator has thought in mind. Just because it is risk, that doesn't mean that the risk should be so high that it blows off the capital. No, that's not going to happen here. So the worst case could be that in 3 years, probably there could be zero returns. That 75 can become 100 or somewhere near to that, and the 25 can not even deliver anything at all. That could be the worst case. And if both sides of the strategy works, then the return could be much, much higher than what a mutual fund would deliver. Yeah.
Okay. Thank you.
Thank you. Yeah. But any other question?
Hey Dipesh, Anmol here.
Yes. Yeah, hi, Amol.
Dipesh, while you have explained the worst case scenario, in your assessment, what's the best
Uh,
case scenario? If you have to, like, average mutual fund will give you 12% CAGR, right?
uh.
So in this, what do you think?
So the best could be, I will write this here and explain. So a 75% portfolio, let's say if this delivers 15% CAGR, okay? And if that balance 25% of the portfolio, if this can give about, let's say, 20% returns, if that strategy works well, then on the best case scenario, then you could see a return somewhere around 20-22 percentage if both sides of the portfolio does well. And compared, let's say if a mutual fund delivers you 12-13%, then this could give you somewhere around 20-22 percentage, but it's all subject to uh, things going good for the fund manager. So I just answered your question. Please don't take this as an assurance that this is what will
No, I
come
got
for.
that.
But this is
Okay.
what you could expect.
And is Parag Parekh also coming up with this scheme or no? Like, what all
No,
funds?
no, no. Currently, only 5 mutual fund schemes have filed for license because the key to this is the fund managers and not there are not many talented people who
Got
actually can run this strategy. So there's there is less talent in the market to actually do this. So there are six mutual fund companies who are actually filed for this thing. Also, whenever it gets introduced, let's say if Edelweiss Mutual Fund introduced this, the name will not be Edelweiss SIF. The regulator has told that this has to be a different brand name altogether. For example, ITI Mutual Fund has called this as Divinity SIF. So it is
Okay.
nowhere connected to ITI. So let's say, for example, if Parag Parikh also comes, it will not be Parag Parikh SIF. It's going to be some other brand name, so that you disassociate the brand Parag Parikh with a higher strategy. That is the intent of the regulator.
Okay.
Yeah. Okay. Any other questions?
Yeah. So Deepesh, I had one question. This is Nitin.
Yes. Yes, Nitin.
Yeah. So my question was that since this SIF is new in the industry, so I mean, not many people would be having the experience of future and options
Yes.
to, I mean, play this kind of strategy SIF.
Yes.
Acha. So I mean, the person who will handle this, who will be handling it? Will it be you?
Okay, so two entities. One is that the mutual fund companies who will be incorporating a separate company,
Okay.
they will be handling this F&Os. And
Okay.
it is we who will be first talking to all these companies and understand that are these the right people to actually give our investors money. So we'll be doing a very deep due diligence in selecting the SIF. But the strategies of which stock to buy, which stock to sell will definitely be handled by the respective SIF company,
Okay.
not us. Yeah.
Okay.
Yeah.
Acha. So that's what my question was. Will there be any prior experience? I mean, will the manager will be having any prior experience of
Yes,
handling
yes,
these
yes,
SIF?
yes. The SEBI in its consultation and its guideline paper have ruled out saying that fund manager with minimum 10 years of experience, only those people can actually run SIS.
Okay.
So we'll definitely not see somebody who is an intern or a MBA graduate in finance will just start off this SIS. That's
Okay.
not going to be there.
Okay. But the research will be done by your team, and they will be, and the SIF will be
Yes.
handled by the
Yes.
respective mutual fund.
Yes. Okay. There is one question which I got it privately, which says that what percentage of exposure guideline that we will be recommending to the net worth of their portfolio. So the answer is that somebody whose portfolio is not 50 lakh rupees, we would certainly, not ask them to make an investment. Only above, if you have 50 lakh rupees and above, only then we would recommend that you should put maybe in one SIO. And depending on your other goals and your risk taking appetite, we will be recommending this SIF to you. But definitely not for all. This is what I could say, because this is a new product. Because this doesn't have any past performance. At least in mutual fund, I could say that look, the history of mutual fund is 30 years old, and last 30 years mutual funds have been consistently delivering 12, 15, 18% CAGR. But this is very new relatively to the market, so nobody knows what will be the performance. So invest only that much of money where you are ready to wait in case there's no returns on it. Okay. And any other questions? And I think we are through to this. And thank you so much for attending this webinar. As we promised that we'll be closing this by 12:30. So we'll end this webinar now, and we have also recorded this webinar. And we'll be sending this recording to you as well in case if you have to hear this once again. Okay. Thank you so much, and thank you for your time. Have a lovely weekend.